India is retooling its industrial grain processing infrastructure to meet new fuel blending targets. First, large-scale facilities are coming online to support this transition. The union government just officially authorized pure E100 fuel, 100% ethanol, as a commercial transportation option. This creates a specific, long-term demand cycle for domestic biofuel manufacturers. This regulatory shift often leads the market to overprice companies based on sector buzz. This graphic shows the split between stocks driven by hype and those supported by actual financial merit. The objective is to filter for asymmetric upside, identifying cases where the potential for growth outweighs the risks inherent in the sector. Capitalizing on the E100 mandate requires looking past the industry headlines and strictly evaluating whether a company's balance sheet supports the investment. Gulshan Polyols Limited was established in 1981. They manufacture ethanol and specialty chemicals, placing them directly within the supply chain for this new fuel mandate. Despite their 40-year history, the company remains a microcap, with a total market capitalization of 1,336 crore rupees. The E100 regulations offer a new demand cycle for domestic manufacturers of this scale, providing a clear path for volume expansion. This creates a specific trade-off: the government-backed growth potential against the extreme volatility and microcap liquidity risks. This chart breaks down how Gulshan generates cash flow across three verticals. Ethanol is the primary driver at 59%. While grain processing provides some secondary revenue, an investment here is a concentrated bet on the long-term demand for India's ethanol sector. When looking at a company of this size, we have to check if the financial foundation can withstand a potential downturn or sector headwind. The Piotrowski score evaluates financial strength based on 9 strict criteria. Gulshan Polyols currently holds a perfect score of 9 out of 9. A perfect score suggests the company is maintaining high operating efficiency and managing its internal leverage effectively. Their debt-to-equity ratio is 0.44. This indicates they fund operations through equity, not high-interest borrowing. This is supported by an interest coverage ratio of 4.56, meaning current profits are over 4 times the amount needed to pay interest. Operational efficiency is also reflected in their debtor days, which stand at 32.5. They are converting their sales into cash in just over a month. While microcaps are inherently volatile, these metrics show a balance sheet that minimizes the risks of bankruptcy or the need for emergency capital raises. The question for the investor is whether this financial performance is already reflected in the current stock price. Over the last 12 months, sales grew by 14.5% and profits surged 354%. Looking at the 3-year trend, sales grew 25.2% annually and profits 35.3%. This table compares those growth figures to the current market valuation. The company trades at a price-to-earnings ratio of 12.4. When we look at the PEG ratio, comparing PE to growth, the figure is 0.35. A PEG ratio this far below 1.0 suggests the stock price is trailing the rate of earnings growth. We also need to evaluate how efficiently management uses the capital to generate these returns. The company maintains a return on capital employed of 18.3% and a return on equity of 16.1%. These double-digit returns indicate that the underlying business model is generating a consistent surplus beyond its operating costs. Management alignment is also high, with the original promoters retaining a 66.8% stake in the company. This level of insider ownership, combined with the return on capital, suggests that management is incentivized to prioritize long-term profitability over speculative expansion. This chart summarizes the risk-to-reward profile for Gulshan Polyols. It occupies a clear position in the high-growth, high-risk quadrant. The trade-off is clear. As an investor, you are accepting the volatility of a small-cap stock and heavy sector reliance in exchange for strong financial health and a low valuation multiple. This profile suits an aggressive growth investor who wants exposure to India's energy transition, but requires the protection of a clean balance sheet and a high Piotrowski score. This is likely not suitable for conservative investors or those who require the liquidity and stability of large-cap dividend stocks. This analysis is for informational purposes only and is not financial advice. Investing in microcap stocks involves significant capital risk. Conduct your own research and consult a financial advisor before making any investment.